Our view is don't try to market time. It's really difficult, but in some cases, remaining invested is a better recipe for returns.
B of A's Savita Subramanian is on Consuelo Mack Wealth Track. Look for it on your local public television station and on wealthtrack.com.
Funding provided by ClearBridge Investments, First Eagle Investments, Royce Investment Partners, Baird, Matthews Asia, Strategas Asset Management, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. American investors have had an on-again, off-again love affair with stocks ever since they started trading under a buttonwood tree on Wall Street in 1792. Well, right now the affair has cooled, perhaps the result of a terrible year for equities in 2022, along with just about every other asset class, and the fact that for the first time in years, yields on fixed income investments are rising and are offering some competition. But this week's guest says stocks have gotten a bum rap and are in fact an excellent long-term investment. And she has the research to prove it. She is influential strategist Savita Subramanian, the head of U.S. equity and quantitative strategy at B of A Global Research. Her responsibilities include U.S. sector allocations for equities, forecasts for the S&P 500 and other major U.S. indices, quantitative equity strategy, and global ESG research. She is, in fact, the head of the ESG, environmental, social, and governance research at the firm, and the first in that position. Subramanian has been named a star analyst by institutional investors for 10 years, with the unusual distinction of being ranked in 4 categories in 2021, including #1 in ESG research, the first time the category was considered. She has also been named to Barron's list of 100 most influential women in U.S. finance for the past 3 years. In part 2 of our interview with her, I asked her to focus on some of the biggest trends investors can take advantage of. And we started with stocks, why we really should own stocks for the long term.
You know, when you think about stocks, they sit in a really good place. They're kind of in between fixed income and real assets, because what they do is they offer you cash return and earnings, just like a bond, but instead of being a fixed amount of earnings and a fixed income, they participate in inflation cycles. Companies can get efficiency and adapt to, problems around them, like we're seeing right now with labor being tight and companies getting more efficient. So I think that stocks are in this really interesting pocket where they can adapt to different macro trends, and it's not just like buying a piece of gold or a fixed income instrument, but they offer earnings that actually participate in the vagaries of the world around us. You know, one of the things that I like about equities is that you can apply screens and look for companies that might be trading at prices that are below what they're intrinsically worth. And right now, I see a lot of opportunities and a lot of mispricings in the market. And one of the quantitative things that we look at is dispersion. We look at the dispersion of valuation. So what we're finding is that there's a very wide spread between cheap and expensive stocks today, which means that there is a lot more potential for finding mispriced opportunities. And that's where I think that investing becomes really interesting and fruitful, is finding those inefficiencies, those mispriced companies where you can really sort of play the long game and ride out the volatility.
Well, another very unpopular concept, which was just the way that you invested in stocks, was buy and hold. And your firm has done some really interesting research on why that is a really good idea and why market timing really doesn't work. Do you want to share some of that research with us?
So we've found that, being invested and instead of market timing can actually be a better recipe for gains. And the idea here is that, if you had, as an investor, missed the 10 best days of every decade going back to the 1930s, you would have made something under, 50% over that entire, century of investments. But
just by missing the top 10 days of each decade.
Of each decade. So this is like you were mostly in there, but you accidentally missed the 10 best days.
Right.
And what we found is that by remaining invested throughout the entire period, you made something close to 17,000%, which is staggering. I mean, there is a huge difference there between accidentally missing out on the best days. And I think the problem is that the best days usually follow the worst days, which is when everybody tends to sell after things really went down. So our view is, don't try to market time. It's really difficult, but in some cases, remaining invested is a better recipe for returns. The other kind of important component of stocks is just the idea of compound return. So if you think about reinvesting dividends, one of the most surprising statistics to me when I started in this industry is that when you buy the S&P 500, and if you just bought it and held it and you reinvested your dividends, you would make hefty returns, and 40% of those returns would be from reinvesting your dividends. So dividends are actually a very important part of the investment decisions.
Now, they weren't, Savita, during one recent decade, right? During the last decade, the 2010s, because companies were growth companies were doing really well, and they didn't pay a lot of dividends. But do you think that we are going to kind of go back, or we are back in a kind of a market where those dividends are really going to matter and will actually improve stock returns over time?
I do. We've been in a very unusual period where multiple expansion, PE expansion, price to earnings expansion has driven a lot of the gains of the S&P 500. And I don't know if we get that, over the next 10 years. I think it's going to be harder to see expanding multiples in an environment where inflation is a little bit more aggressive, where rates are a bit higher. You don't have those tailwinds. So, over the last 10 years, I think something less than 20% of your returns came from dividends. But going forward, we expect to see a much more sizable proportion of returns coming from cash return. Another trend that happened over the last 10 years was that companies switched from paying dividends to buying back shares. And our view is that, both make sense, but dividends are more of a commitment to shareholders rather than buybacks, which are sort of a one-time strategy. So we love companies that have the capital discipline and say, we're going to return a certain portion of our cash to you on a regular basis.
You told me something really cute at one point, that you view stock buybacks like having a date, whereas paying dividends is a marriage.
Yes, stock buybacks are
how
dating.
We should look at it.
Yes,
right.
Exactly. Stock buybacks are dating. Issuing a dividend, a regular dividend, is like getting married, and you are in it for the long haul, which I think is an important signal.
Another big trend for investors has been this massive move to passive investing, to buying index funds, to owning the entire market versus active management. And index funds have indeed done better than active managers, or I should say that active managers have underperformed over a long period of time, have underperformed indexes. How do you advise investors about those choices?
I think that there's room for both passive and active. Passive index funds offer investors a way to get market exposure without paying high fees, which is wonderful. As a part of your asset allocation decision, having exposure to equities, fixed income, commodities, gold, all of it, passive offers you an easy way to get exposure to asset classes. And I think that's really important. At certain times, I think that active management becomes more fruitful. And I believe we're actually heading into one of those periods where, the inefficiencies in the market today might actually be greater because of the fact that there are fewer fundamental investors around. So, when you think about what's been marginalized over the last 10 or 20 years, we've seen a lot of kind of longer-term stock selection strategies being replaced by either passive investing or quantitative investing, or sort of faster trading strategies. So I actually think that today there might be better opportunities for longer term stock selection strategies, just given that that's not where the eyeballs are. So there are a lot more inefficiencies in the market because not that many investors are looking at stocks quite that way.
There's another, screen that people are investing in, and that's called ESG. And you are head of ESG research, environmental, social, and governance strategies at B of A Global Research. It's come under a fair amount of criticism because ESG is such kind of an amorphous term, and it's very difficult to measure its results and to measure the outcomes. What's your assessment now of ESG now that it's been around for quite a while?
It's interesting because I think that ESG is it's sort of a brand that's been applied to a way of thinking about investing that is not new. And when we talk about investing, if any investor worth his or her salt will think about the risks of, good governance or, flight risk of top talent or, environmental infractions that could cause lawsuits. These are things that we've thought about since day one of investing. But now I think what's interesting is that they're being codified and more formally integrated into the process. Companies are being encouraged to tell us more about how they're thinking about managing their workforce and environmental risks and decarbonization. The approach we've taken at B of A within research, I think has been really stable and is really apolitical and almost amoral. But what we're looking at is, when you're assessing a security within a certain sector, what are the environmental, social, and governance risks that most matter for that company relative to its peers? And what we're finding is that it's not necessarily an ethical decision, but if you have a company built out of innovative people and you treat them really badly, they're going to leave and go to a competitor. So social factors tend to be very important for growth companies. Whereas if you are an energy company and you can incur, costly fines from safety or, environmental pollution risks, those are some of the factors that will be most germane to your business model. So our approach has been to look at this from an economic perspective and really say, okay, when we are allowed to look at all this information that companies are now sharing with us, how can we improve our returns, and think about companies more holistically rather than just all the metrics we learned in business school. I think at some point we'll stop calling these strategies ESG because I think that that really every investor has a sustainable approach, right? I mean, there's a branding issue, and there's actually what good investors are doing. And I think that when we're picking securities or when we're thinking about the risks of our portfolio.
Another big change that you've been tracking and writing about is deglobalization. What are the investment implications of deglobalization, and do you think that this is a lasting trend?
Probably where we settle is we're in a global economy, and that's never going to change. But I think the way we're thinking about doing things is a little bit different. One of the reasons is just geopolitical risks. Information risks, national security, cyber security. Those are some of the issues that are starting to become more top of mind for companies. When you think about other reasons for shifting supply chains, it's just the idea that, a lot of the emissions that companies incur are from moving stuff back and forth around the world. So an easy way to decarbonize is to sort of shift your operations facilities closer to your consumers. So that's another kind of uncorrelated reason for reducing supply chain length. And then on top of all of this, I think that we've also gotten to a point where country risk is becoming more volatile. And we've seen this, you typically see this during periods of geopolitical strife. But, again, when you think about just energy security, if you're a nation that relies on another region for oil, that becomes a risk factor versus producing your own oil and being self-sufficient. So I think all of these factors are sort of popping up at the same time. Where we settle over, the next 10 to 20 years, there are many experts out there that know far more about this than I do. But my sense is that we end up somewhere in the middle, not in an environment where we've just come right back to a protectionist society and it's all happening in North America. I think that's hard to imagine at this point. But I do think that there are important changes that are taking place for all the reasons that I just mentioned.
And from an investment point of view, so you think multinationals used to be kind of the way to invest, and they also paid decent dividends, and you would get exposure to emerging markets, and those were all of the reasons for investing in these multinationals. Has that changed?
There are parts of that value proposition that we need to rethink. And here the idea is that companies are going to figure out where to go and how to do business and how to be economically viable, but it might take a little bit of time. And in that process of rejiggering supply chains, you might not see that steady stream of earnings and dividends that we've all become used to. So I think with any sort of shift in terms of broader secular themes, we need to discount that by maybe assigning a slightly lower multiple or a higher risk premium for companies that are grappling with shifting supply chains and geopolitical risks. And I think the market has been really good at sussing that out, because what we're seeing is that country risks are now really factoring into the actual cost of capital for lenders and for equity holders. It's kind of remarkable to watch the market and market participants essentially price that into companies in a real-time fashion.
Savita, demographics, the world is aging. How do you figure that into your investment strategy and recommendations?
I think that what that does is it still continues to put pressure on companies to produce income. And I think income is a theme. Dividends, this is a theme that we've been talking about for a while, and I think it becomes even more important as we go forward. Inflation-protected income, I think, is a very important theme. When it comes to demographics and demand, I think that what that does is it provides a broad secular support for healthcare, for aging, for some of these longevity themes that we've been writing about. Healthcare is a big part of that secular growth. I do think, though, that, even in the U.S., when you think about population, we still have a pretty sizable chunk of Gen Z, millennials. There is a pipeline of new employees that actually exceeds baby boomers now. So, I think that demographics aren't as dire as maybe we were making them out to be in prior cycles. And
at least here they're not.
At least in the United
in
States.
China and Japan, they are.
In other regions,
so.
It does look more problematic. But in the U.S., it actually looks relatively healthy on a comparable basis.
Who are the big winners going to be in the markets? In the last decade, big tech dominated, and specifically big U.S. tech companies. Is there going to be that kind of concentration in the market and that kind of dominance, do you think, in this decade?
I think that technology will still continue to be very prominent. It shouldn't even be a sector. It's almost a process that you apply to all sectors. Where we're seeing potential for real margin expansion and productivity gains are in, labor-intensive companies that are starting to automate or, use AI and artificial intelligence to become more efficient. Companies within the sort of decarbonization space, both energy, traditional fossil fuels, as well as green energy could both outperform the market together over the next several years as we, sort of think about how to get to a better place from an emissions standpoint. You're going to need traditional commodities as well as the nascent technologies. So I think that we're in an environment where leadership could broaden out beyond just mega cap tech, which is which is really bullish. And we could also see a lot of these companies that haven't necessarily been as efficient as they need to be really improve from a productivity perspective. And I actually think that is very bullish for the cost of capital of stocks, for margins, for multiples of companies, because we haven't seen productivity gains in earnest in a very long time, and that could be the next bull market.
One final trend, the New World Order. It's a New World disorder. There is a tremendous amount of uncertainty, geopolitical uncertainty. Are there investment implications to that and things that we should be doing in our portfolios as a result?
Oh, definitely. I think that what this sort of geopolitical friction translates into is potentially higher inflation, a greater emphasis on self-sufficiency from a national perspective. It's unfortunately, potentially negative for immigration, which puts even more pressure on wages. At the end of the day, what this means is it really necessitates companies with intellectual property making sure that they are residing in friendly nations and friendly residences. Right. And I think that's what hastens a lot of the reshoring. It's not necessarily driven by, COVID supply chain risks or even decarbonization. Those are nice to have, but the real mandate is national security. And I think that is what is creating this pressure on technology companies in particular, or intellectual property oriented companies, to figure out how to, kind of shore up their IP.
So cybersecurity firms, for instance, defense companies, again, are those are sectors that you think are going to grow and that have possible investment potential?
When I think about, kind of how we're approaching geopolitical frictions, it seems like efforts are being fought on different platforms. There's a tech war. There's sort of an information security war. There is, typical, defense and weaponry, but I think it's not necessarily as simple as just buying, defense companies if you're in wartime. It's also thinking about all of the information risk, the technology risk, and that is a war that's being waged on a very different battlefield. So cyber, I think, is an important theme as an investment process, and it's relatively nascent. But I think the number of cyber attacks that we've seen in the U.S. is staggering, and probably most of us don't realize what's happening behind the scenes. So that might be the new kind of field for geopolitical friction.
The one investment for a long-term diversified portfolio, thinking again about these long-term trends, what is there an area that we should all be investing in?
I'm a quant, I'm a numbers gal, and we run all of these different screens. And the one screen that I find kind of the best kept secret in investing, it's called Quintile 2. And all it is you take the market and you sort it by dividend yield. And instead of buying the highest dividend yielders, you buy that second quintile, that second bucket. And what we found is that it's kind of an eerily efficient way of buying low and selling high, and avoiding downside risk, because you end up with companies that pay a reasonable dividend, not a super high dividend. And what's good about that is that companies that are about to cut their dividends tend to see dividends rise to these precipitous levels. So you avoid that downside risk. And then you also have a value component, because when a company's price goes up a lot and its dividend yield starts to come down, you sell it and you lock in that gain. And what we found is that this quintile has offered the highest return and the lowest probability of losing money in kind of any type of market, whether it's a bull market, a bear market, a falling interest rate, rising interest rate market, kind of an all-weather strategy. So if I were on a desert island and I could only pick one screen of stocks, it would be Quintile 2 by dividend yield.
Savita, so lovely to talk to you about big trends in part 2 of our interview with you, and thanks so much for joining us.
Thank you, Consuelo. It was great to be here.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is a familiar one to Wealth Track viewers, but it bears repeating. It is avoid market timing. The reason is simple. To win, you have to be in the game. An analysis of the market provided by BofA Global Research shows that if an investor missed the 10 best days of any decade since 1930, they would underperform the market by a huge margin in each decade. On average, an investor missing the 10 best days saw 33% returns over the last 9 decades. Being in the market, the returns were nearly 19,000%. To get the full benefit of stock market returns, staying invested is the best strategy.
Next week, Mike Clarfield, veteran portfolio manager of the ClearBridge Dividend Strategy Fund, explains the many benefits of owning dividend-paying stocks.
In this week's extra feature, Savita Subramanian shares her techniques for keeping at the top of her game as a consistently top-rated strategist in a very competitive field. Please follow us on Facebook, Twitter, and our YouTube channel. Thank you for spending time with us on this Memorial Day weekend. We are so grateful to the men and women who have sacrificed their lives so we can live in freedom and peace. Have a wonderful weekend and make the week ahead a healthy, profitable, and productive one.